Welcome to the Kentucky Retirement Systems Investment Committee meeting. It's May 21st, 10 a.m., and we are broadcasting via Zoom or Facebook and teleconference. Let's see, Pruitt is not here today, so I am filling in. We have called the meeting to order. Is there an opening legal statement?
Yes, ma'am. This is a regular meeting of the Kentucky Retirement Systems Investment Committee. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statutes, Section 61.826, and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. Please ensure that you are on camera when making or seconding a motion or casting a vote. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. Sherry, can we do the roll call?
Yes, ma'am. Ms. Bova?
Here.
Ms. Hampton?
Here.
Ms. Thompson?
Calling roll. Yes, I'm here.
Oh, thank you. And Mr. Lane? Thank you.
And okay, so moving on, I believe, Sherry, you said we have no public comment.
That is correct. No public comment for today.
Thank you. And so we'll move on to the approval of the minutes from February 18th, 2026. Do we have any discussion? Corrections? Could we move to approve?
Don't move.
Do we have a second? Can I second it?
You can.
Okay, second. Okay. Minutes have been approved. Thank you.
Oh, you probably need to say all in favor. Sorry.
I'm sorry.
Motion and second.
Thank you. Thank you. All in favor?
Aye.
Aye. Any opposed? Okay, minutes have been approved. Thank you. Let's see. Okay, so now we are going to come. Steve is going to update us with the investment review. An update, please.
Good morning. Appreciate everyone's time. First, before we jump into performance and allocation, I'm going to have Craig, who is on the line from Wilshire, provide highlights of economic and market conditions for the third quarter of the fiscal year. So, Craig.
Thanks, Steve. And I'll start on page 9. And I'm going to keep this pretty high level because these pages mostly cover the first quarter, and a lot's happened since the end of the first quarter, which I feel like every other meeting we're saying, let's go through this quickly because a lot's changed since the end of the quarter, but it's again true. So here you can see by the headline, it's the first, second, and third most important issues that are on our mind right now and driving markets are U.S., Iran, and Strait of Hormuz, right? Obviously, the joke there being that all three are the same thing. There's one main event that we're really keeping an eye on because it's driving so many other things. So you can see the dotted line here represents February 28th, roughly when military operations began. And you can see in the top section of this chart, the traffic through the Strait of Hormuz essentially grinding to a halt within a few days of that. And the next two sets of lines look at Polymarket. So essentially like a betting site, but essentially beyond, like sports betting. So it's a one gauge of how markets are pricing in probabilities of things that we don't, when we reference things like the probability of interest rate cuts, we have derivatives where we can look at the pricing to determine the probabilities associated with how the market's pricing things. These newer websites allow for pricing on things beyond the traditional futures contracts or other derivatives we would use to try to suss out what the market's really thinking. So we can see here that based on these sites, the probability that the market was pricing in of the Strait of Hormuz reopening was very low. And obviously we've gone through the end of April and it's still not fully truly open again. The probabilities in the bottom panel of the announcement of ending military ops by the end of April and June, at the time, the market was pricing in about an 80% chance that this would all be done by the end of June. I would imagine that number is significantly dropped, especially, today we heard that Iran essentially said, you're not taking the uranium or plutonium out of here, which is obviously going to be one of the main key points that the U.S. was going to be asking for here. So if we move on to the next page, we can see here that, again, this dotted line carrying over from the end of February, even leading into that commencement of military operations, the market was already kind of seeing the carrier movements and the troop movements and expecting that something was potentially coming. And we can see that the expectation for 1-year inflation started to jump and carried on after the operation started up to about 5%. It cooled off after that, but I think we're now seeing it start to tick back up. What's really interesting on this chart, though, is that you see in green the 1-year break-even inflation, but if you go down to that red dotted line, that's 5-year expected inflation 5 years from today, and that line's actually flat or even slightly lower than it was at the start of the military operation. So roll that into the 5-year inflation expectation today, which is only ticked up slightly, you get a 10-year expected inflation that's still, at the time of this chart, 240. So really little impact on long-term inflation expectations, the impact really being felt just in the 1 and 2 year break-even numbers. We'll see as this drags on how the market and the Fed think about the impact of the oil price shock and other goods that are affected by the Strait of Hormuz. We'll see how that evolves as this drags on. If this had only lasted a few months, I think it'd be easy for everyone to say, okay, it was a transitory event. It'll flow through in a few inflation readings and move on. The longer it drags on, the harder it is going to be to make that case. So as of now, we might still be in a situation where we can get out of here with this being pretty transitory. I hate to use that word because the Fed used it going on 4 years ago now, and obviously proved to be a big mistake. But if these operations can wrap up in the relative near term, hopefully a situation like these charts are predicting where longer term inflation isn't really affected could play out. If we move to the next page, I'm only going to hit a few more pages and turn it back to Steve because market performance, we could talk about how stocks were down, US down about 4% the first quarter, non-US a little less than that, but all those changes have been really dwarfed by what we've seen so far in the second quarter. But these types of topics, these are things that are lingering and expected to have really big repercussions depending on which direction they swing next. But we can see that, again, that February 28th dotted line, the market expectations for a couple of cuts this year, maybe even up to 3 cuts looking out to March of 2027, that's gone to 0. So 2 interesting things here. The market's expecting that the Fed won't cut rates now this year when they were expecting 2 potential cuts. But interesting here that they haven't swung to expectations of rate increases. And this was, as of when these materials were produced a few weeks ago. If you look today, by the December meeting, the expectations are 37% chance that rates are unchanged come the end of the year. Now the market's pricing a 42% chance of a rate hike by December and a 20% chance of 2 or even 3 hikes. Now the 3 hike scenario is 2 or 3% chance. So it's really the market has swung since these charts were produced above that 0 line to expecting a greater probability of 1 hike than staying where we are at this point. So obviously the inflation expectations, the implications for Fed policy, these are the big picture things that are really on our mind as we continue here into the second quarter. Because as we move forward to page 16, something we've been talking about for about a better part of a year now the U.S. objectives and the risks associated with them. And we've talked about, the administration potentially trying to run the economy a bit hot and grow its way out of the deficit situation. One of the big risks to that is rising interest rates. So you can see here, reduce the strategic objective, reducing the annual percentage deficits. Again, you can do that by cutting spending or the percentage deficits based on GDP. So you could grow GDP faster than those deficits. But rising rates make that a harder objective to achieve. And we can see why in the next page. In the bottom of page 17, we can see, just using very round numbers here, every 1% change in interest rates, and this is not necessarily today's interest rates because this is a blend of debt that's been issued over a number of years. So even if rates went up 1% tomorrow, we wouldn't necessarily see the cost of servicing the debt that's already out there go up immediately. But as debt matures and new paper has to be issued, that would take effect. But it's about a $400 billion impact for every 1% change in the effective rate. So that could go up or down. If we, part of the reason the Trump administration was pushing so hard for further rate cuts is because, you cut rates of a percent, you could see 400 billion in money that's not going to service the debt anymore. So this pressure on inflation, that puts pressure on rate hikes, that puts pressure on the borrowing costs of the outstanding debt and the cost to reissue as debt matures, has implications on further deficits and spending policies. So that's why these are interconnected and big picture issues that we're paying a lot of attention to. And with that, I think I'll cut it there, keep it relatively short this quarter. Obviously, like I said, a lot of stuff has changed. These materials were produced, sometime in late April, about a month after the quarter ended, and we've seen a lot of stuff happen in those subsequent 3 weeks since then. But Steve, I'll turn it back to you and see if you had any further comments there, or keep moving along.
No, that's great, Craig. I appreciate it. And again, it's always hard, kind of having these meetings 6 weeks after the close and talking about stuff that seems like ancient history. But I think you hit on the things that continue to be topics, top of mind conversations. And I do think it's interesting on, I talk about it a little bit here, but we've seen the sell-off in rates, especially on the long end, despite kind of what I would say are kind of those muted forward inflation expectations. And I think that, to your point, really has to do a lot with the potential, the focus on debt burdens going forward, given the, higher for longer kind of rate expectations. And I think that's been a big driver of kind of that sell-off especially on the long end of rates. So, Sherry, could you turn to page 39, please? I also wanted to take an opportunity. I believe he is on the call. So Colby is our summer intern for the Office of Investments. So Colby, typically this is where we have you sing your college fight song. So take it out. No, you can. I'd be happy if you want to introduce yourself and say a few words. That would be great.
Yeah, just thank you guys for having me. It's been a good first week. Excited to learn and to just get rolling. So thank you, Steve.
You're welcome. Welcome aboard.
Okay, wait a minute. We need a little bit of information. Are you UK or U of L?
UK. I go to UK.
Okay,
We won't hold it against them.
that's right.
As Craig alluded to, the quarter, whether it's the first quarter of the calendar year or third quarter of the fiscal year, was really a tale of two halves, with risk markets producing solid returns in January and February, only to give it all back in March, really, as global markets navigated that volatility that Craig talked about, dominated by the conflict in Iran, that really oscillated almost daily and has continued to between escalation and de-escalation, whipsawing energy and risk markets across the globe. Disruptions to regional shipping, as Craig pointed out, and energy infrastructure pushed oil higher as global equities reflected a broad risk-off tone and worsening sentiment, while monetary policy expectations were re-rated significantly, as Craig touched on, in response to those higher near-term inflation expectations. The other hot topic, artificial intelligence related disruption, remained top of mind, with software and memory stocks selling off and concerns growing about exposure in the private credit markets, and several semi-liquid private funds in the headlines as they reported repurchase requests exceeding their 5% NAV quarterly thresholds. Consistent with this broader market backdrop, after posting positive performance in January and February, the portfolios declined in March, pushing the performance for the quarter into the modestly negative territory. The KRS pension composite produced a return of minus 52 basis points for the quarter, but did outperform the blended benchmark's return of minus 95 basis points, while the KRS insurance composite produced a return of minus 89 basis points, also outperforming the return of its benchmark by 37 basis points. Individual portfolio performance for the quarter ranged from down 44 basis points to down 95 basis points, with all of the portfolios outperforming their respective benchmarks by between 31 and 55 basis points. During the quarter, the largest contributors to outperformance were the relative performance in the real return and specialty credit portfolios. The specialty credit portfolio produced a return of positive 42 basis points, outperforming its benchmark by 94 basis points, with 15 of the 17 portfolio managers outperforming their respective benchmarks, really led by the opportunistic credit strategy that outperformed its benchmark by 240 basis points during the quarter. The real return portfolio outperformed its benchmark by over 450 basis points during the quarter, with exceptionally strong performance in the portfolio's MLP, toll road, infrastructure strategies, as well as the internal proxy portfolio. The largest drivers of underperformance, a bit of a broken record during the quarter, was the overweight and relative performance of the public equity portfolio, which trailed its benchmark by 27 basis points. Jumping to fiscal year to date, the KRS pension composite has produced a return of 5.74%, outperforming the blended benchmark's return by 98 basis points, while the KRS insurance composite produced a return of 5.43%, outperforming the blended benchmark's return of 4.76%. Through the first 3 quarters of the fiscal year, the real return portfolio has produced 811 basis points of outperformance, while the specialty credit portfolio has outperformed its benchmark by 217 basis points. Those are the largest contributors to outperformance relative to benchmark. Now, following on to after the end of the quarter, public equities reversed sharply in April, with U.S. markets up over 10% and non-U.S. markets up 9%. High yield bonds were up almost 2% for the month, while core fixed income was flat as yields rose across the curve. April performance is still preliminary, but the portfolios performed well and are indicated up between 350 basis points and 450 basis points for the month, which would bring fiscal year to date returns to between 9.5% and 10.5%, with strong performance relative to their benchmarks. Jumping to May, we've seen a follow-on to that April, with sentiment cautiously recovering, but volatility remaining high. As of this morning, U.S. equities were up about 4%. Notably, however, global rates have sold off this month, with U.S. 10-year peaking at 4.67% and the 30-year peaking at a 19-year high of 5.18%. In this environment, we really remain cautious. Reversals in stock leadership and elevated stock-specific risk continue to be key themes. Option markets reflect expectations for this to continue, with the CBOE S&P 500 dispersion index rising to over 39, marking almost a 10% increase year to date, a 10-point increase year to date. The 90-day rolling correlation between the S&P 500 and the U.S. bond market volatility index has reached its most negative level since 2020. And that really suggests that equities are increasingly sensitive to that bond market volatility. As Craig touched on inflation, and while inflation is still expected to cool later this year, as we saw by those forward rate expectations, and move closer to the Fed's 2% target by 2027, but having run significantly above 2% over the last 5 years, and further increases likely to occur as a result of the continued conflict in the Middle East, and with emergent price pressures in a few categories that appear unrelated to tariffs or energy prices, inflation could be more persistent than anticipated and becomes a salient risk. For now, the path forward looks uneven, and that uncertainty feeds into rate expectations and that higher for longer environment, which is not unlikely to go away anytime soon and could pressure risk markets. Page 41, please. The internal portfolios have all performed in line with expectations and objectives during the quarter and for the fiscal year to date. The majority, again, of these assets are passively managed and intended to replicate the return and risk of public market indices, providing inexpensive beta exposure to more efficient markets while providing staff flexibility and rebalancing and the overall allocations within the portfolios. On this report, I would note the performance, as I touched on, of the real return proxy portfolio that outperformed the benchmark by 827 basis points during the quarter and has produced a return of over 32% fiscal year to date, outperforming the benchmark by over 28%. Page 47, please, Sherry.
But Steve,
Yes.
on that, if it's supposed to be mirroring the market, why are we up so high?
Well, we're up so high because the constituents of how we construct that portfolio, there's not a true, as we know, for that real return, we use CPI plus as a benchmark.
Okay.
And we've talked about the breadth of that asset class. So that's the underlying constituents. We have exposure there to materials, metals, a number of different asset classes that we actively position based on expectations and outlooks for those asset classes.
Okay, so the benchmark is not like following the S&P 500 or something like that.
It's not. Yeah, that's
okay.
it's CPI plus 300.
Okay, that makes sense. Thank you.
You're welcome. A few highlights from the quarter. Staff continues to actively renegotiate fee schedules with our existing external managers. During the quarter, staff successfully renegotiated management fees with the public high yield manager, lowering fees by 12%, saving the systems an estimated $500,000 a year. Other highlights, the majority of assets were transferred in kind to the new Oaktree managed public leverage loan account. Given the nature of these assets, final transfers are expected to occur by the end of June. And based on the continued attractive risk reward profile, compelling market opportunity, and current real return allocations, staff made an additional commitment of up to $100 million in the IT Rail Fund to be shared among all KRS and SPRS portfolios. Details of that can be found on page 68 in the report. And following an extensive review, we've talked about it on several occasions at recent meetings. Staff transferred asset management responsibilities of the MSCI ACWI ex-US public equity mandate from Franklin Equity Group to ClearBridge, and ClearBridge is a member of the Franklin Templeton overall firm. This change is expected to improve the quality of the overall international portfolio with improved performance, less risk, similar growth, and lower tracking error. The details of that decision can be found on page 71. At this point, I'll turn it over to Joe to talk about the public equity portfolio.
Okay. Thank you. Just one thing on the Franklin Templeton ClearBridge. That is in transition at the moment. So it's not been completed, but we're in that process. So I think Craig and Steve have covered the markets really well. If you'll go to page 48 for me, please. Just a couple quick comments. The first quarter of 26 really kind of started out as a continuation of 4Q25, where we saw the market starting to broaden out a little bit. This was evidenced by the equal weight index beating cap weighted index. And so this is something that we've kind of been looking for some time. The market narrowness had really been a headwind for us across multiple strategies. This was hopefully going to be an opportunity for our external active managers to really do some stock picking and add some value. Looked like it was going to kind of go that way for January and February. Small caps started to outperform large caps. Value outpaced growth, which was kind of different than what we've been seeing for several years now. So we were pretty, I guess, excited about the opportunity. And then with the Iran conflict, kind of everything shifted. Where AI had once been the one variable we were concerned about, now oil became the big variable. You heard Craig mention that's their top three concerns is oil, essentially. And so if you look to the right there, you see on that first chart, kind of the oil exports out of the Strait of Hormuz, and it just fell off a cliff, as Craig had mentioned. And so you see to the right of that next chart, the price of oil spiking and the inverse action of the markets in response to that, falling off that kind of cliff in March. And so we've seen a reversal kind of in that, as Steve alluded to, in April, strong month in April. But pre-Iran, like I said, AI was the big story. There was a fear in the software industry. Pretty much everything in the software industry got hit pretty hard. It was thought that everything would be adversely impacted by AI. And throughout this quarter, it's kind of people are starting to discern a little bit that while, yes, it's going to be disruptive for lots of software companies, there's going to be some that actually benefit. So there's some potential opportunities where multiples have really been compressed in that part of the market, for maybe some opportunities to pick up some names there. Speaking of opportunities, anything in the electrical or AI infrastructure is intriguing. Defense and industrials are potential opportunities, and power and energy generation is something else that people are looking at. We've kind of talked about software being a potential high risk area. Long duration growth that are at high multiples is another thing you kind of want to be leery of. Anything that's going to take some time for that growth story to play out, but you're having to pay up to be a part of it. You're kind of taking on some risks there. So those are some areas we probably want to try to avoid. Sherry, if you might go down one more page to 49, international markets. They started out really well. They got hit really hard in March, falling 11%. Despite that, they still outperformed their U.S. counterparts for the quarter. Growth forecasts have actually stayed pretty consistent. There was some talk about rates earlier and staying higher for longer. That seems to be the case across the globe. Developed nations are keeping their benchmark rates a little higher with concern of near-term inflation. And then I guess one thing to note, the earnings forecasts really haven't changed that dramatically, which would imply kind of a shorter lived conflict as far as what the market thinks. We'll see how that actually plays out. Something that's kind of interesting, after U.S. dominance for quite some time, international markets, the last 5 quarters have outperformed. Despite that, they continue to trade at a pretty significant discount. If you go down one page, you'll see that discount in the top right chart. So that's the multiples for domestic versus international markets. And you see the international markets are sitting at pretty sizable discount at the moment. As far as our performance, Steve kind of touched on it. Global equity allocation was down 3% versus a market that was down 2.8. Really, it says stock selection strength. I think that might be a typo on my part. It should have been weakness in the international markets, kind of what drove our issues there. Our U.S. allocation down a little bit more than the index, fairly in line, down about 4% for the quarter. Stock selection was split. Allocation decisions didn't really impact relative performance too dramatically. And in the international markets, we were down 120 basis points versus 68. And that's really those growth mandates that have struggled. We've talked about that. Steve kind of talked about a solution that we've worked to make a change in the roster there. Hopefully, we think that's going to be benefit. Our deep value mandate performed well. Our active emerging market mandates, those performed really well for us in the quarter. So there were some bright spots as well. And then maybe slide down one more page, Sherry. For the 12-month ended at the end of the quarter, we were up about 19.4 versus a market that was up about 20.6. We had broad-based weakness across the portfolio, and that was really due to that market narrowness and some of our style and factor bets that just haven't played out well. There was a low quality, high volatility kind of market headwind against us. The market wasn't very discerning when it comes to quality defined by earnings. It was anything related to growth has run pretty strongly at the beginning of this 12-month period, and we have a quality bias in most of our strategies, so it was hard for us to keep up in that. Our regional positioning being a little bit overweight, non-U.S. equities was a benefit to the portfolio. They've outperformed for this 12-month period the U.S. by about, I believe, 5% now. So that was a benefit for us. Outside of that, I don't really have any further prepared comments.
I'll just add, Joe. Yeah, I'll just add, Joe. This, as Joe mentioned, and he alluded to a lot of the factors driving performance. I would say the underperformance of our active portfolio relative to benchmark is not unique to us. Not certainly in the pension world, but across the board. Active management has really struggled in the recent environment. I think the Wilshire would agree with their data that it's been a struggle. So that underperformance is certainly not unique to our managers. I think Joe does a good job of staying on top. And as we mentioned, we just went through a process of reviewing one that we had concerns about and shifting management to a different team within the same organization, which we think will improve the overall quality and risk profile of the portfolio. If no questions for Joe, I'll turn it over to Brian to cover fixed income and liquidity.
Thanks, Steve. Sherry, I'll start on page 52. Thank you. At quarter end, the yield curve had flattened as interest rates rose across the curve, with oil prices surging, causing inflationary concerns and weaker prospects for the Federal Reserve to cut rates in 2026. The 2-year rose the most, finishing at 380. That's up 32 basis points from last quarter. The 10-year rose 15 basis points to finish at 432. Those movements caused the 2-year spread to reverse its steepening trend from last quarter by flattening about 17 basis points, ending the quarter at 51. Next page, please. Thank you. Even with the rise in rates, the core fixed income portfolio was able to generate a positive return of 4 basis points for the quarter and 329 basis points fiscal year to date, outperforming the benchmark by 9 and 19 basis points respectively. CMBS, ABS, and MBS once again were the top 3 performing sectors for the quarter, with MBS leading the way, generating 40 basis points in total return, followed by CMBS and ABS producing 32 and 31 basis points in total return respectively. Investment grade credit spreads widened 11 basis points for the quarter on a combination of risk-off tone and heavy market issuance, with $721 billion of new issues hitting the market. Preliminary numbers for April show the portfolio up about 17 basis points. Next page, please. Thank you. The specialty credit portfolio earned 42 basis points for the quarter and just over 5% fiscal year to date, outperforming the custom benchmark for both time periods. Lower quality issues underperformed during the quarter, with BB, single B, and triple C rated issues returning -28, -65, and -126 basis points, respectively. And next page, please. Thank you. High yield spreads widened 50 basis points during the quarter to an option adjusted spread of 317. In March, high yield bond indices posted their first negative total return in 12 months and their worst monthly performance since October of 2023. And again, just preliminary returns for April are currently showing public high yield up 169 basis points. Next page, please. Craig has pretty much covered most of this slide, so I'll just go to the bottom part of it and just let you know for the quarter, cash has generated 92 basis points in return, with the fiscal year to date producing just over 3%. And this is the last page for me, and I'm happy to take any questions.
If no questions, I think, Sherry, you can go to 58. Anthony couldn't join us today, so I'm going to do my best at covering the alts markets. The alternative asset portfolios really had a mixed performance during the quarter. The private equity portfolio returned -73 basis points as higher interest rates continue to unfavorably impact buyout math and valuation multiples, leaving thousands of companies, as we've seen reported in the press, lingering in aging funds. The portfolio did benefit from three true exits to external buyers during the quarter, each of which returned over $10 million to KPPA. Real estate markets and sentiment have continued to rebound, with the open-ended diversified core equity index posting a 6th consecutive positive quarter after 2 years of declines. Our real estate portfolio produced a modest 20 basis points return during the quarter. The portfolio's 3 open-ended core strategies all returned over 1% during the quarter and continue to outpace the ODCE benchmark over the last 1, 3, and 5-year periods. And the real return portfolio, that was our real standout as we've covered. During the quarter, it gained 6.1% compared to the benchmark's 1.6% return. The portfolio's MLP manager, again, energy prices were very positive, managed to gain 22% during the quarter and is up almost 30% annualized over the past 3 and 5-year periods. So it's been a standout performer. The portfolio's active closed-end fund strategy was down 2.9% during the quarter, but still up 21.4% over the past year. So a little volatility there, but consistent long-term performance. Page 89, please, Sherry. Thank you. I think everyone knows these are some of my favorite charts. I think it really distills down all of what we do in the portfolios into a couple of very simple graphs and metrics. And all of the pension and insurance portfolios have produced exceptional risk-adjusted performance over the reported 1, 3, and 5-year periods. And that's based on Wilshire's all-public plan universe, with all of the portfolios producing Sharpe ratios in the top 5% of Wilshire's peer universe over the 5-year period. Again, we really believe this is an important metric as the asset allocation guidelines that are provided by the investment committee and the board determine the specific risk parameters and constraints under which staff constructs and manages the portfolios. And these risk-adjusted return measures demonstrate the efficiency of the performance that is produced by the portfolio. So we think that's very important. Page 21, please, Sherry. As of the end of the quarter, all asset classes for the portfolios were within the IPS specified ranges, with the majority of positioning within 1% of their respective target allocation. During the quarter, staff took opportunities to rebalance the liquid asset classes toward their respective targets. Again, kind of that cautious outlook on the markets. We maintain an overweight in public equities, partially as an offset to the underweight in the private equity asset class. In core fixed income, as Brian mentioned, we continue to evaluate potential opportunities given the significant move we've seen in rates. We're currently positioned neutral overall in duration and yield curve. And as managers have called and deployed capital in the real return portfolio, we have unwound liquid proxy positions to fund these investments, and we continue to work on additional investment opportunities in that asset class. As you'll note, the largest underweight remained in private equity, as staff has viewed the asset class as having limited value from a relative risk-reward basis, with better opportunities available in other asset classes. As we talked about, we brought a recent private equity investment opportunity that the investment committee and the board approved. We've begun to focus more on the asset class, kind of as that recent underperformance that we've talked about and the funding difficulties have created a more attractive landscape. So we would expect to bring more of these opportunities to the investment committee and the board in the future. Page 143, please. Very quickly hit on the investment budget. Through the first 3 quarters of the year, we spent a little under $5 million, or 42% of the amount budgeted for the full fiscal year. Within those broad categories, consulting services were in line with 63% of the amount budgeted for the year spent year to date. Legal and auditing is the standout, so the largest outlier, with only 6% or $300,000 of the amount budgeted for the year through the first 3 quarters. So thank you, Michael and Vicky. And that's really as a result of some of the cases that have concluded, and we've seen less activity in some of the ongoing cases than we had originally anticipated. We will be reducing the fiscal year 27 budget for legal services by $1.6 million, as some of the open cases are expected to settle. But as always, Michael wanted me to caution that depending on activity, we could see a significant increase in the amount of legal expenses. In the contractual services category, 87% of the budget has been spent. A few items to note in this category. Expenses for custody service are running well above the amount budgeted, And that's primarily as a result of increase in market values and increase in transactions and account activity. We will be adjusting the budget for fiscal year 27, kind of based on the new expectations for expenses going forward. And we are anticipating an RFP for custodial services in the first half of the new fiscal year. Several of the services, including Solovis and ISS, are billed annually with a full amount already paid for the year, so you won't see an increase in what we've already paid for the fiscal year. And you also may note, and Joe's on the call, so I can have him talk to this. You also may note the variability of the expenses for the Giant Guevara. That firm provides legally required tax accounting services for investments in our international public equity portfolios, primarily in India. And as Joe's told me, the timing for these are very difficult to estimate. We often receive invoices for multiple periods, multiple years simultaneously. So you'll see years where we pay nothing. And then as you see this year, we paid what looks to be about 3 years worth of fees.
Yeah, so those are just tax consulting services we have to have in India, also in Taiwan, and it's just part of investing in those local markets. And they're just very inconsistent on their on the timing of their billing. We'll go several years without an invoice, and then all of a sudden they want to catch everything up in that random week that they send them to me, and so it's hard to budget.
Joe usually has about 2 days to pay those.
Yeah, they don't give a lot of notice, but we do. I mean, it's within we match them up versus our contract, so they're appropriate. They don't send them in a timely fashion. So we budget for it every year, and there's several years we won't spend anything on it, and then another year where we play catch up. So it's just a difficult line item. So,
well, thank you.
And the-
146. Sorry.
The accountant in me is going to ask Joe a question, and that is, Joe, if you know what it is, can you accrue it?
That would be our ops team that does that. I mean, I think we try to account for it on this particular sheet to you all every year. But as Steve mentioned, if you look to the left of that green bar, there's several years where it's just no actual expenses occurred, and so we're aware it's coming. We just and I think that our ops team accounts for that. We just don't know when the actual expense is going to take place. Is all. So, but.
Okay, thanks.
And Lynn, I appreciate the accounting question. And if it was a material expense, much like our performance fees or anything that would impact performance or participant accounts, I think that would be worthwhile to consider maybe trying to do an accrual. But given the size, and again, that's the size for the entire, that's spread across both trusts, right? So all of the participating plans, it's going to be immaterial from a performance standpoint.
Right.
I think. Again, if it was larger and material, we'd certainly consider some type of accrual for it.
Yeah, that 140 is across 10 plans for 3 years. So it's not going to move the needle from a performance perspective. So.
Thank you.
Page 146, please, Sherry. Thank you. At the total pension level, investment fees and expenses declined by 5.2 million or 4% from the same period last year. And that's despite a 13% increase in the total assets. The largest drivers of the decline were the 10.3 million decrease in performance fees and expenses in the specialty credit asset class and the 5.7 million decrease in performance fees for the private equity class. These decreases were partially offset by the increase in the total investment management fees, and that was really across all asset classes, largely driven by the increase in market value of each asset class. The largest increase was in the real return asset class, which increased by 4.2 million, and that is as staff has continued to build out portfolios towards their respective asset allocation targets, increasing total assets in that asset class by 375 million or 27%. As I mentioned kind of at the opening that in the highlights for the quarter, staff continues to actively negotiate fee schedules with existing external managers. And for new or existing managers, we target an effective fee rate that are in the lowest quartile of the manager universe. Staff, as I mentioned, recently renegotiated one contract with an estimated savings of 500,000 to the systems. Over the last year, Joe has successfully renegotiated management fees with 7 of our 14 public equity managers. annual fee savings of approximately 4.6 million with a weighted average savings of 30.1%. So kudos to him. 12 of the managers now are now in the cheapest quartile of the manager universe, and one sits just outside of the lowest quartile. At the total, that all wraps up into a total pension level on a weighted basis. The overall investment management fees are approximately 31 basis points. Again, that's across the entire portfolio. The combined KRS pension portfolio is in line with this weighted management fee rate, with a fee rate of 30.3 basis points. Core fixed income has the lowest weighted average management fee of just 6.3 basis points, which does account for the internally managed portfolio. And the real estate portfolio currently has the most expensive weighted management fee rate of approximately 84 basis points. So that's all I have. Happy to take any questions.
I would just like to say thank you for the efforts to reduce the costs. I think it's just a good, it's good for the participants, and I appreciate your all's diligence in focusing on that.
Thank you very much.
Good morning. I'll wrap us up here with the quarterly investment compliance report for the quarter ending March 31st, 2026. For that quarter, all of the policy-based guidelines were in compliance during that period, no exceptions to report. You can go ahead and go forward 3 slides, I think. As you've previously seen in the materials, asset allocation compliance was consistent throughout the quarter, and the proxy voting reports are up on the KPP website as required by state law. I'll wrap up by saying that if you have a moment this morning while you're logged on to check your KPPA email, there's an email from Sherry from earlier this week asking about availability for a special called investment committee meeting. And if you haven't already responded with your availability, I'd greatly appreciate if you can take a look at that and get back to Sherry. Thank you for your time. Let me know if you have any questions.
All I can say, Carrie, is this is really dull. Congratulations.
That's how we like it.
I don't have the agenda in front of me. Sorry. Okay, we're over here. Oh, look at that. Time to adjourn. Anyone have anything else? Okay, great. Nice to see you all. Have a wonderful day. We're
Thank you
adjourned.
very much.
All
Thanks a
right,
lot.
thank you.
Thanks.
Thanks.